I mean,
not if you have a good CPA.
yes. Yeah, of course, there we go. We come back to the CPA.
Yes. Just one more point, just make sure it's an approved charity with an identification number. Renee, we get these questions. We want to make sure you have the ID number of the charity. Like Red Cross and any major, they have an ID number, absolutely.
Yes.
You want to make sure it's an approved charity and that you didn't set up some charity on your own and it's not deductible.
And
so
you pay either by check, credit card, or if you're paying cash, then you should have a proper receipt.
Yes, and I'll make two follow-up points, is that many people, out of the goodness of their heart will give money to a particular person, with the best of intentions, but that's not a charity for a charitable deduction. And then another thing we see a lot of clients giving is giving money to overseas charities, charities in India.
Right.
And very rarely will those qualify for a U.S. tax deduction. Most of the times they won't.
Most of them, they have their chapters here, the 501c, and
then you want to do it to the U.S.
You want to give it here, and then they may give it out there. That's
exactly.
From the tax point of view, Renee, they look at an ID number. We need what you call an employee identification number. You have that. We are good.
Okay. All right. Then let's go through the whole tax planning tips, and you have those 10 golden rules in planning, tax planning.
Yes. So the top 10 we came up with, David Letterman and us in the same category.
That's right.
So what we just start with number 1, make an extra mortgage payment, if you can, because our feeling is that it might get restricted next year. They might start reducing it.
So this is the month that they can do it? Or
yes. So if you made 12 months, you might want to add another one, call it 13 payments, so you'll get a deduction this year for the interest part.
For the interest portion.
Interest part of the mortgage.
I see.
So most people try to accommodate that. It will not going to hurt them in a big way. Okay,
so they can add one more this year?
That is correct.
Okay, so one more mortgage payment, that'll help in the tax planning.
Absolutely, and reduce their tax burden. Okay. Second is maximize your 401k plans, and I cannot tell you how many people I encounter, even students and people. It's $17,500, so and if the company matches it, you're really leaving money on the table, Renee, so maximize that. And that's a great tax benefit, so make sure you take care of that.
Okay, so cardinal rule 3.
3. So it's a Roth or if you don't have a 401k plan, you're not lucky enough for the employer to match it, then you go into an IRA or a Roth IRA. Every on earned income, $6,000 every year you can set aside in a regular IRA.
For an IRA, $6,000.
$6,000.
And I was going to say, and even if you're covered by an employer's plan, there's nothing stopping you from also saving on your own.
I mean, that's correct.
My question here was, a lot of times people have had their IRAs very fragmented, maybe 1 year, then 5 years nothing, 10 years again, and people forget.
Yes.
Now, is there any way that they can, is there like a central system that they can check through the Social Security how many IRAs one has had all these years? Because it could be from different time in different places.
Each brokerage company or financial institution that you have an IRA with is supposed to give you a form, kind of like a 1099, that shows the value of your IRA every year.
Well, let's say somebody had it 10 years ago, 15 years ago, then they stopped. And
you should
still moved out from that place and you have no idea.
So what you can do is you can go to the IRS and request a transcript of your account.
That's what I wanted to know.
And you'll get to see, who are all the people that have told the IRS that they have, assets or income for you. Then you can use that as a roadmap to start consolidating your IRAs into one place. And then work to financially build it and continue savings. So you have to send a letter to the IRS? There's actually a form. It's called a Form 4506 to request an IRS transcript.
And they can go back to, from the first time you put out an IRA.
There is a time limit, but again, every IRA brokerage firm is required to provide a statement to you every year, regardless of whether the account is dormant or not. So that should be available through the IRS.
Yes. And most of the custodians, or I call them custodians or trustees of these, if you just happen to know it's Merrill Lynch or whatever name you're holding or the bank, and they'll go back and give you their records and start consolidating. But you're right, Renee, you need to keep track of this because you've kept this money aside and it's tax-free because it'll be taxable when you start taking it out.
Exactly. Now, considering a Roth conversion, why?
Yeah,
Sure. What a Roth IRA is, it's different from a regular IRA. Roth IRA is being invested with after-tax money. You've already paid tax. But the wonderful thing about a Roth IRA is that money, when it grows and you take it out, you never pay tax.
Right, because it's already paid.
It's already been paid, but it's a special feature to the Roth that the earnings on that Even when you take it out at retirement age, you're not taxed, okay? So how do you create a Roth IRA? Well, one way is to take your existing IRA
And convert it into a Roth
and
IRA.
convert it. Now, that conversion is
Gotta pay
treated...
taxes.
You pay taxes. It's as if you sold it. So you pay tax on the value.
How
but
much
the-
taxes do you pay? Let's
Well,
say
you
you had
pay-
a 6,000.
It's added to your income. So if you have a low income year,
Okay.
it's not that high. If you have a high income year, it's at the
So best to
highest rate.
convert it at a low income year if you're
Correct.
a freelancer.
Exactly. So getting back to, if you think tax rates are going up next year, this would be a good year to bite the bullet, convert the IRA, pay the tax, and so that future growth,
Right.
when we think, tax rates are only going to go higher,
Right.
as the decades go by, this is going to be tax-free
So
money.
what's the maximum limit to have the Roth IRAs, or like 6,000, 10,000, because you're consolidating all the IRAs
Well,
into Roth?
Two things. If you're doing a conversion, you're
Yes.
taking existing IRAs and converting to Roth, there's actually no limits.
Okay,
You
Interesting.
could convert 2,000 or 200,000.
okay.
If you're making a new
New one.
contribution to a Roth IRA every year, there are limits, and it's the $5,000 and $6,000 per year
I
that you
see.
can give, and there's some income limits.
I see.
Okay.
And then we have the AMT probably?
Yeah, the AMT is an alternative minimum tax, and the fear is if Congress doesn't act, there's hundreds of families will get affected by that, Renee.
Of course.
I have a strong feeling, but that's just my feeling, like everyone else, that it will get fixed.
Fixed,
It's
yes.
called an AMT patch. They expired 2010. It got 12. We extended till 11/12, and I have a feeling it might get fixed because they do not want to affect or upset, I would call it, the middle and lower income,
Right.
because those thresholds are going lower and lower. So
Yeah.
a lot more people will be caught in the fishnet.
Right.
So
Well, we're
they're
going to
going-
have a whole show of this, the tax landscape for
Yes.
next year, because we're talking about fiscal cliff and all these issues that are coming in with
Absolutely.
bipartisan
Absolutely.
politics. Yeah.
And it'll come across as very, very bad to the whole public because they will treat it like a tax increase. And that's never a good thing for no matter who's in power or whether it's federal, state, or city. It's just something I don't think the public is. And it also might trigger another recession because those tax rates will be really pretty onerous on the middle class.
Right. And then your FSA, utilize your FSA, 2,500, use it or lose
it's
it.
a
That's an important one.
flexible. It's called a flexible spending account. So in the beginning of the year, you elect certain amounts like co-pays and doctor's visits that are not covered, that you are paying out of pocket.
Okay.
That is actually a tax-free benefit from the top. It's always good to have that. If you don't have that, and if your employer offers it, I really think we should
So
suggest
does it come
that.
under itemized deductions?
Well, that's something that's issued by an employer. So
Yes.
if your employer offers that, you want to be sure to take advantage of it.
Correct.
And if
Okay.
you've already taken advantage of it and you've put money in, Cecil's point is that you have to use all the money by the end of the year,
Correct.
otherwise,
But
under the law,
let's say
it's
you're
lost.
your own employer, you're a freelancer, then this doesn't apply to you.
The FSA doesn't apply to you, but you still want to look and see, your medical deductions are, you put them all in a category, and to the extent they exceed 7.5%, you get the
Of your
deduction.
income.
Right.
You get the deduction for the amount that exceeds 7.5%. So since we're so close to the end of the year,
Right.
you have to think, okay, what medical expenses have I incurred so far? And what are the major medical expenses do I know I'm going to incur? Do I need to have braces for my kids or elective surgery? So you need to look, because if I'm far away from reaching that 7.5% threshold in 2012, I may want to put off that big expense until 2013.
Right.
Or if I've already exceeded the threshold in 2012 and I was going to get the braces in 2013, I want
Right.
to get the braces in 2012.
I see. But then for those who are on 1099, how do they work it out? It's going to be itemized deductions, if not standard deductions?
For the most
them?
part, it's an itemized deduction. There's some
Right.
special rules for 1099 employees, but the basic
Okay.
rule applies.
What about Rule 7, dividend cash and considering after tax effect and investment opportunities?
Okay, go ahead.
Yeah, if capital gains distributed, see, we are really skeptical. We are not sure. At this point of time, it's all 15%. So you want to avail of the benefits at the 15% rate. But that's why, like I said before, a lot of the dividends are being pushed out, being capitalized in this December month,
Right,
so we can
right.
pay a lower rate of tax. But related to that is the long-term capital losses also. So if you can you're capped at 3,000. So if you had a loss of 10,000 on a capital loss, your max is 3K. You'll carry that forward. The
I see.
7K will go forward.
So on a related point, if I've had a strong year and I've sold some stocks at a gain, but I have other stocks that I haven't sold, but they've lost money,
Right.
okay? I may want to consider selling those stocks that have lost money to wipe out the gain and therefore
Okay.
pay less tax.
Right,
Right? I
right.
mean, I have to what they call realize the gain. I have to sell the stock at a loss to offset
Right.
that stock
It
that
has to
went
be
up.
done by this end of
It
this
all
year.
has to happen in the same
December
calendar year.
31st.
Right.
December
So
31st.
a lot of homework for a lot of
Absolutely,
people.
Yes.
absolutely.
And college tuition.
Yeah, very important point. I think a lot of students have what I call missed this credit. It's a refundable credit, and most of the folks are, they don't avail of this great credit, and it's going to expire in 2013. So 12 and 13, make use of that credit.
Right.
Okay, so if your kid is in college and they have earned income and they can avail of that credit, so you need to take that American Tax Opportunity Credit because it won't
Now, what
last.
if you went through college a few years ago and you didn't use that?
You can still file an amended return.
If you're within a 3-year window, you
Yes.
can
The
go
3-year
back,
window.
Yes.
amend the
Right.
return, get
But
the...
not
Yes.
more than 3 years, that's it?
Generally speaking, 3 years.
I see. And you want to talk about the tax calculation, some tips on that as well?
Sure. So what we also want to do is we want to avoid penalties, right? So the IRS wants us to pay our taxes as we earn them. They don't like us not paying taxes during the year and then paying everything on April 15th.
Right.
But it gets back to the other rule of tax planning we said was pay taxes as late as possible. So what you want to do is you want to look at what you think your 2012 tax is going to be. And then you want to look at your paychecks and see how much tax have you had withheld. So as long as the amount that you've had withheld is at least 90% of what you think your tax is going to be,
I see.
you can pay that extra 10% on April 15th without having a penalty.
Right.
The other option is you can actually look at your last year's tax. And if your withholdings this year are in some cases 100% of last year's tax, in some cases 110% of last year's tax.
Right.
Even if then you'll be immune from penalties, and then you pay the difference on April 15th. Okay, so we want to put as much and pay as much on April 15th as we can, but you obviously want to know what that amount's going to be now, so you're not surprised by
Right.
the bill
Exactly.
on April 15th. So cash flow planning is very important.
I'd add to that, Renee, always be on the safe side, have a caution. You can't cut that. You estimate your income, pay the tax, and you'll be in good shape. But don't underestimate the income because that triggers penalties.
Right.
And that is not a good thing to have. So if you can overpay a little,
And then get
and
back.
you get back a
That's much
refund or
easier,
apply it to the next year's taxes.
Right, right. And very quickly, want to touch on international tax issues.
Yes.
Compliance, compliance, compliance.
Yes, and like we've said before, Renee, in all our segments, it's never too late to comply, but look at your global position. I call it GPS, global
Yes,
position, because
absolutely.
you have money all over the world, and you want to make sure that you're optimizing your tax position.
Absolutely. Be a global taxpayer, be a smart, savvy taxpayer,
Correct.
and compliance is the rule that we're going to talk about.
And I'll just add the concept that as a U.S., either a green card holder, citizen,
Right.
or even here on a H1, the U.S. tax law is based on a worldwide approach.
Right.
You pay tax. It doesn't matter if your bank
Where you
interest
are.
is in India or it's in New York.
Yeah.
It's part of your U.S. return. If you're paying tax somewhere else, you get a credit. But it
Yes.
starts with
Absolutely.
reporting everything on a worldwide basis, and that's the
Absolutely.
fundamental basis that a lot of people don't understand.
Yeah, the FBAR, we talked about
Correct.
it many, many times, so it's
Correct.
important, international tax, issues are very important. International tax planning is very important these days. So you're a global taxpayer. Well, thank you very much, gentlemen, and we're going to be talking more about the tax landscape for 2013 in our next show. So thank you, Cecil Nazareth. He's a chartered accountant, and Vinay Navani, who's a CPA, Certified Public Accountant, and he's also with the tax firm of Wilkin and Guttenplan. Thank you very much, gentlemen. And I'm Renee Lobo. Thank you so much for watching the Renee Lobo Report.
Thank you.